Though structured settlements are common these days, questions and misconceptions often arise regarding their use in the settlement process. My guest is structured settlement expert and planner John Darragh. John, welcome. Thanks for talking with us today.
How are you doing, Scott?
I guess to start things off, one question would be, why are interest rates so low in structured settlements?
Well, you know, I've been hearing that interest rates are low since I started in the structured settlement business over 20 years ago. My response when someone says the interest rates are low is I usually say compared to what? If you compare the internal rate of return of structures to CDs, treasuries, and other types of similar risk profile taxable investments, there's no contest. Some of those investments do have some more liquidity, but in terms of the actual interest rates, addressing that interest rate question, structured settlements provide a very attractive long-term rate of return. Structured settlements should not be used for short-term duration types of investments.
John, one might think that they could do better just investing in the stock market.
Well, you know, that also is a common question that people have, but suppose you had put your money in the stock market in August of 2008 or the early part of September 2008, and 3 or 4 months later found yourself down 20 or 30%. Many of the people that do structured settlements are people who can't afford to take risk, and some of the people who are prospects for structured settlements are people who have little to no experience investing in the stock market. Even the best money managers, even the people who are managing billions of dollars in mutual funds or hedge funds, people lost money. I wrote a blog post a few weeks ago saying, where should you put your settlement money now? And what I did is, in fact, I will have a link to it at the bottom of this particular video. But you should take a look at it because it shows on February 4th the market tanked that day, and it compares what the relative value of the particular drop in the market would be for someone who, for example, had $1 million to invest. One of the questions that I ask people when I meet them the first time is I say, look, if I give you $1 million to invest and I came back to you a month later and said it was only worth $900,000, how would you feel? I really haven't had too many people that have said they would feel great about losing only 10% of their assets, but frankly 10% swings are something that could happen in the stock market on any one given day or at least any one given week, and we saw what happened in 2008. Those of us who've been around long enough saw what happened in 1987 and at various other time periods. So if you have somebody who just cannot afford to take risk, they shouldn't be in the stock market. Even those that do put money in the stock market, most financial planners will tell you that you should look at the investment classes and have a balanced portfolio. A structured settlement should be the conservative part of your portfolio. What it does is it offers an attractive, conservative, long-term rate of return. If you have a structured settlement and you have that steady rate of return, steady income coming in, you can theoretically have more opportunity to take more risk because you've got the insurance effectively on the back end.
John, I'm sure people would wonder if they could roll this over to take advantage of higher interest rates later on.
There's a natural ebb and flow, Scott, of interest rates. Okay, you have periods of high interest rates, periods of low interest rates. The stock market goes up and down. The bond market goes up and down. The real estate market, as we've seen, goes up and down. So when you do a structured settlement, you're doing it because you want to have a conservative long-term rate of return. It is possible that some period of time after you do the structured settlement, interest rates can go up, and you're getting a lower rate of return than possibly could be out there in the marketplace 2 or 3 years later. One can't be clairvoyant of exactly what interest rates are going to do in the future. There have been talks that because of the U.S. government deficits that interest rates are going to have to go up. But on the other hand, I believe it was Ben Bernanke who was quoted as saying that interest rates are going to be exceptionally low for quite a long period of time into the future, or at least the next several years into the future. So we're hearing conflicting reports, but in terms of what's the best today, okay, structured settlements have a place in anybody who's a personal injury victim's portfolio. It provides that conservative rate of return that's free of management fees and other investment charges associated with mutual funds, hedge funds, and other types of more volatile types of investments. It has a place as an asset class in any person's portfolio.
John, is my insurance company failing something that I need to worry about?
In this type of economic environment, that type of question comes up fairly often, Scott. It also came up back after the 1987 crash. It came up after the savings and loan crisis in 1992 and the failure of one company, Executive Life. But the reality is that if you look at just at the current economic crisis as an example, where you had last year, I believe it was the FDIC said there was 140 bank failures where the banks were taken over. Just in 2010 alone, we've had over 25 bank failures. Now, during the same time period, there has not been one structured settlement annuity issuer that has been taken over by a state insurance department. Now, think about that. Not one insurance company has been taken over, okay? And people who have structured settlements are receiving the payments that they depend upon month after month after month. And you should feel very comfortable if you have a structured settlement that that is going to happen. Now, there are some protections, certain things that you can do to increase your chances in the event, in the unlikely event that something happens, such as using a secured creditor status if it's available, using what's called a qualified assignment release and pledge agreement. But when we're thinking about these companies, using, for example, New York Life. New York Life has been around since the early 1800s. If you think about that over that time period, 150, 160 years, I mean, how many wars have we had? How many panics, economic crises, Vietnam War, oil crisis? I mean, they have ridden through the Great Depression. And in the most recent economic decline, New York Life has maintained its AAA ratings and A++ best ratings all across the board. The other companies around, some of them may have been downgraded slightly, but they are still maintaining superior high ratings. These are the companies that issue structured settlements, and somebody who has or is considering a structured settlement should take comfort in the fact that, again, while there have been numerous bank failures, there hasn't been a company that issues structured settlements or recently had issued structured settlements that has stopped making payments or has been taken over by a state insurance department.
What does the insurance company get out of these, John? What's their motivation?
Well, one is, as a consumer, one is naturally skeptical when somebody's offering something. What's in it for them? Or, there are people in the structured settlement industry that would have you believe falsely that virtually every casualty insurance company is on the take and taking a kickback from their structured settlement brokers or other vendors, and that's just simply not the case. I covered this actually in a recent podcast about using outdated information, which I encourage people to look at. But what I'm saying is, if you are a plaintiff attorney, if you are a plaintiff, if you are a judge who's naturally skeptical about this process, don't lose sight over the fact that this is it's an excellent economic vehicle for people of virtually any level of sophistication, because it provides guarantees, contractual guarantees that one simply cannot get from any other investment.
My guest has been structured settlement expert and planner John Dara. John, this has all been great information. Thanks for talking with us today.
Well, thank you, Scott. I've enjoyed being on the show.
This is Scott Drake, and you're watching the Legal Broadcast Network.